The monetary policy response to 2020's COVID-19 pandemic and the recession that followed has been of a scale and form never before seen. Not only have policy rates been brought to the lower bound by central banks across the world, but clear guidance has been given that these rates will remain there for the foreseeable future, that is years, not months. Yield curve control and asset purchases have also dramatically increased policy's effect by lowering longer-term market interest rates for both the government sector and the private sector. With COVID-19 vaccines now showing promise, we need to begin to assess if this expansive monetary policy support will act as a catalyst for a rapid return of consumer inflation. This will dictate the sustainability of the current stance of policy. Asset prices have certainly responded rapidly to the stimulus provided. This effect was first seen in US and global equities' strong rebound from their lows, as a dramatic drop in term interest rates reset valuations and portfolios are reallocated towards long-term growth opportunities. Progress towards an effective vaccine has since provided additional support, boosting expected profitability. For housing markets, price weakness quickly abated across the world. In the US, even when the unemployment rate was above 10% in April through July, 6-month annualised 20-city house price growth remained robust, June's 3% gain seemingly the cycle low. Australian home prices did fall, but only by about 3%, as low interest rates boosted affordability and lockdowns and work from home requirements increased the value of the family home. Come October, national prices rose once again. Whereas asset prices have and likely will continue to show strength as a recovery builds, this is not the case for consumer inflation. The primary determinant of the decision to spend or save in aggregate is household income rather than wealth, and income is dictated by the labour market. Despite the monetary support given, the labour market recovery looks as though it will prove protracted across the world. Each developed nation has taken a somewhat different path in response to the pandemic, and so have their labour markets. Nations such as the US, which only provided limited direct support for businesses' wage bills, experienced an initial sharp spike in unemployment and underemployment, which unwound as their economies reopened. While US unemployment and underemployment have both more than halved since their mid-2020 peaks, labour market slack remains a multiple of that seen prior to COVID, particularly if former workers who have left the labour force are also counted. For countries such as Australia, who aggressively supported businesses through the crisis to keep workers attached to their employers, the rise in unemployment and underemployment was much less aggressive. However, the deterioration in employment prospects is expected to continue into 2021 as government support is reduced. Across the developed world, full employment of the labour force is therefore a distant hope. For as long as this excess supply of labour remains, wage growth and hence consumers' discretionary purchasing power will remain constrained. This is both a domestic and international concern, with global excess capacity needing to be used up before wage growth and consumer price pressures can sustainably recover to or above central bank targets. Despite the support offered and the strong response of financial markets, we therefore concur with central banks across the world that the risk for consumer inflation is that it continues to disappoint. An upside surprise would require a material, sustained uplift in wages growth across the global economy and a willingness on the part of consumers to spend this income. In the absence of such a surprise, the RBA and other central banks will maintain extraordinarily accommodated policy settings for the foreseeable future. We'll see you next week.